Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 203 today. And today we're going to talk about the SIP experiment that we have been doing on a non-public portfolio, a not so high return portfolio, but the effort is to try and showcase what SIPs can do over time, regardless of market volatility. So in terms of the market was reasonably volatile, although the underlying sentiment remains strong. We see that some public sector enterprise, some PSU banks and energy stocks lost some ground, but more or less we were in firm territory with Nifty closing at 0.6% higher and real estate and pharma picking up along with infra. Most of the sectors were in either near flat or positive. The only sort of lacking part was that market was still iffy, and despite there was talk about reconciliatory talks between Russia and Ukraine, market remains a little on the edge, but nevertheless much better sort of sentiment in the market than what was there at end of February or start of March. So almost all broader indices clocked between 0.5% and 0.6%. And some of the weekend investing strategies did very well. MI30, MI35, MI25, MI MTL cap did very well. MI EverGreen was down as gold was down today, and NNF10 also suffered some loss, but more or less reasonably in the ballpark of where the benchmarks are going. In terms of the major gainers in the CNX 500 universe, a lot of action in the pharma and fertilizer space. So you can see here Rashtra Chemical up 13%, Himadri Speciality up 13%, Birla Corp up 10%, Glaxo and TANLA up 10% each, and Future Consumer down 19%. I mean, this is a crazy stock actually. Hero Moto down 7%. That's a big cut on Hero Moto. But Man Textile also minus 7%. This is also pretty large drop today. And Bank of Maharashtra down 7%. And TATAELXSI, I mean, everybody was going too bullish on TATAELXSI yesterday. We also highlighted the gains on TATAELXSI, and I guess TATAELXSI is down 5%, sort of taking a break from its relentless run. So we are, as I said, we are running a SIP experiment. This is a portfolio in front of you, 20 stocks, started at the peak of the market in October 1st. 26 weekly SIPs are in. Original portfolio is up 10%. So if you had invested 1st October in the portfolio and rebalanced every week as per it would have been up 10%. The SIPs that have come in weekly have resulted in a XIRR of 22%, but still early days. 6-month XIRR is something that we should not take too much of relevance in terms of returns, but nevertheless, I mean, this is the current 6-month position. XIRR is an annualized internal rate of return, so 22.4% is the annualized internal rate of return based on the various inputs of the capital that have come in. So the idea is to showcase that despite market volatility, despite the fear in the market about market going down, and market actually did go down from 18,600 to 16,000 something, and it is still lower than where it was at the highs. Still the portfolio is positive. It is positive at 22% XIRR or 10% of lump sum original portfolio. So what I'm trying to get at is that a lot of times we feel that the market is not doing well, or we may not do well when we invest in the market. But if we are investing in a self-correcting strategy like all momentum strategies are, then we need not fear the market as much and just continue to plow in the capital, and the strategies will take care of the returns themselves. So I will continue to update on this portfolio every week as I put in more and more money into this, and hopefully in a few years I'll be able to showcase you the impact of just staying with the strategy. And it's a very nominal return strategy. Maybe it will yield me somewhere close to 15%, but and it is very similar to my EverGreen, which is also based on CNX 200 stocks. So you can see here, I've been tracking the XRR and the absolute returns from December onwards. I started this in October, and I've been tracking these numbers since then. So you can see that while the underlying absolute return is 0.6% on CNX 200, the absolute return on the portfolio is already plus 10%, and the XRR has gone to plus 22%. So more updates will come on this, but I hope you are able to see that with a underlying self-correcting strategy, you are able to get the best of both worlds. When the market is falling, you are able to accumulate more stocks, and the stocks that are going out of your strategy are forgotten, and you need not regret about those. So self-correcting strategy is basically that it will automatically keep removing stocks that are not performing and bringing the stocks which are performing inside. Another insight that I tweeted today was this Nifty Next 50 and several other indices that are going through a major reshuffle at the end of 6 months. Every 6 months, the Nifty Index Committee changes the composition of all the indices, and there are so many indices now. There are, I think, maybe more than 20 indices, but the major ones: Nifty Next 50, Nifty 200, CNX 200, CNX 500, Small Cap 250, Small and Mid Cap 400. I mean, these are the ones that we track. And there are a lot of changes in all of these indices. I think in CNX 500 index there are like 35 changes. In CNX 200 also there are like more than 15 or 20 changes. So huge amount of churn is happening, and these index or indices themselves are self-correcting portfolios. So if somebody just investing in indices also can never really go wrong, because the exchange is your fund manager in that sense. And they are removing all the stocks that are not performing and bringing new stocks in. The index committee has recently changed their criteria for stock selection. Earlier it used to be a minimum of 3 months of market data. So any stock which comes and lists should have a history of 3 months before it can be selected for these indices. But now it has been changed to 1 month only. So many of these stocks, newer stocks, have also started to come in. So Nykaa, Paytm, Zomato, they will all enter the Nifty Next 50, which is a very important Nifty Junior index. A lot of passive money runs on Nifty and Nifty Next 50, and one of our strategies, NNF10, also runs on this. So let's see how this performs. In case these stocks do not perform, they will never come in our portfolio selection, so we have no issue with that. But yes, it is a major shift from having conventional stocks into more newer kind of stocks. So this is all I had for today. Thank you so much for watching these episodes, and share them with your friends and family. I'll see you in another one. Bye.